Hello and welcome to this Tuesday's morning market briefing. We've got a lot to talk about, but firstly, biggest US companies warn of growing AI risk, as well as that Fed's Daly backs gradual interest rate cuts as inflation confidence mounts. We've got lots to talk about on the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. But the first article we'll talk about is to do with, the biggest US companies and the growing AI risk. Over half of the US's biggest companies are now stating that artificial intelligence is posing a larger and larger threat to their businesses. This comes following a new survey of corporate filings that show that AI could bring about massive industrial transformation. Now, of course, the topic of AI is one which we've now frequently discussed on this channel. Over the past few months, arguably the past 6 months, we've really increased the frequency at which we talk about the topic of AI, and that's largely because AI is posing not only a greater and greater threat to certain industries, but also greater and greater opportunities to certain industries. And on this channel, we need to look at both to understand where markets might be heading. And of course, the AI revolution, which is seemingly taking place as we speak, is massively affecting markets as a result, and that's why we're kind of keeping our eyes on it. Now, if we kind of think of those key topics that we usually associate with AI, well, it's Nvidia and it's other key tech stocks, especially the likes of Google and Meta even, who are investing billions. I'm not sure about billions, but they're investing a great deal of money into their AI infrastructure. And also, of course, their machine learning models, which they're using to kind of get ahead of the competition. As these key tech companies, and the largest tech companies, ultimately they have massive data sets, which they can use to train these AI language models. And also, the kind of industry that they're in means that they can utilize these machine learning models to a great extent. And that's kind of been, the greatest opportunity that AI has presented itself. It is kind of within these industries of search engines like with Google, or for certain tech items like the Apple's iPhone, which can incorporate machine learning models into functions like Siri, or it's Meta, who can maybe utilize the topic of AI to help with copyright issues or safeguarding issues. It's all these kind of small things which obviously massively impact the way that someone might use a piece of technology or a certain application, and therefore many are investing great deals of money into this kind of AI revolution, and as a result, of course, Nvidia, that stock that we're always talking about on this channel, has benefited the most, seemingly, as it is kind of underpinning the AI revolution with the Nvidia chips, which of course they produce and kind of have a monopoly over almost. But ultimately, what this article presents, rather than what we're usually talking about, which is opportunities, as I said at the start, is that there is a growing AI risk. Now, I do believe that we've spoken about this a few times on this channel, just nowhere near the amount that we speak about the opportunities. And ultimately, AI does pose a significant risk to certain industries, especially. As you can see here, the graphic, which of course the Financial Times has used, or the photo that the Financial Times has used to, used for this article, is ultimately one which represents a key industry, of the arts, of media, which is being massively affected by AI. And many within the industry are, as a result, very, very worried about, the potential ramifications should AI be utilized rather than human labor or human capital. And as we can see here, it's the Screen Actors Guild protest in Los Angeles, where many were kind of worried, especially about screenwriters losing their jobs due to the kind of use of AI. As if we can kind of just think, AI could basically fill a great deal of the function that screenwriters offer. Many would argue that it lacks the human creativity. But if you look at it from, a pure business standpoint, if a consumer can't tell really a difference, then to a business it's kind of just a no-brainer to possibly utilize a cheaper, if it is cheaper, of course, a cheaper kind of technology than using actual human labor and that kind of thing. So that's the kind of key worry for those working in that field especially. But of course there's other industries around the world, especially also within the arts, which initially weren't expected to be affected by, of course, the AI revolution, but now increasingly are being seen as an industry which will be affected by the kind of use of AI. And now all of these individuals are starting to worry about their own lives, about their own livelihood, and what they can offer to society should AI just take up their roles. So that's the kind of key thing that's seemingly being noted within these corporate filings, and that's what this survey's picked up and is now reporting on. With now 56% of Fortune 500 companies citing AI as a risk factor in their latest annual reports, according to Arise AI. This figure has risen from a tiny 9% back in 2021. 33 out of the 108 companies that were surveyed discussed the issue of generative AI with an optimistic outlook and saw it as an opportunity. Sorry for me butchering that and not reading it correctly, but ultimately 33 out of those 108 that did talk about AI essentially spoke about it in the more optimistic view. Now, more than thirds of those of the group that spoke about AI instead said that generative AI posed a serious risk to business. So ultimately, when people are talking about AI seemingly now, when businesses are talking about AI, now seemingly the worry is actually, AI, not the kind of potential that AI might offer. And so this is kind of what we've been talking about when we've been talking about the AI revolution, is how this will affect different industries. What industries might this actually create, but at the same time, what industries might this destroy? And ultimately it's going to be up to governments and therefore nations to kind of decide what they want to do with this risk, as ultimately many could argue that by limiting this kind of AI technology, if you're worried about the effect on industries, we could see that other nations around the world that aren't as scared about, losing certain industries to AI and more so just focused on the competitive aspects that AI offers, we could then see that those industries start to excel, or those nations start to excel economic-wise better than those that are limiting their AI capability. So this is also another worry. Ultimately, how will governments respond to this is the key question. Now, this survey information shows that generative AI is already having a serious impact on a number of industries, and especially at the majority of the largest listed companies in the US. Key AI risks that were mentioned in their recent financial reports include the topic of greater competition, with many companies now having to invest billions and billions of dollars to develop new AI infrastructure to run or create new generative AI models. And that's kind of what we spoke about at the start there. But obviously, we'll keep you updated on this topic, but it's definitely one to keep your eyes on and think about when we're always talking about AI, is the kind of downsides that AI does pose. That's all talk about in this article. Next article we'll talk about is to do with Fed Daly. Now, this is obviously on the topic of the Federal Reserve and interest rate cuts, with the president of the San Francisco Fed, Marley Delm, saying that the Fed needs to take more gradual approaches to lowering interest rates. This comes as the world's leading central bankers prep to meet at their annual meeting in Wyoming this week. And that's obviously the Jackson Hole meeting, which would, of course, mark the kind of year anniversary of this kind of channel, basically, as we did start to make these videos just after the Jackson Hole meeting, just as we were coming out of that. So it's quite amazing to see this channel come full circle. But ultimately, of course, this topic is of great interest, as ultimately on this channel we're always looking at what the Fed's doing, what the ECB is doing, and what the Bank of England is doing, so we better understand the dollar, the euro, and the pound, as these are kind of leading currencies of the world, and therefore leading central banks that we have to follow to understand what's going on. Now, of course, the topic of US inflation has been a really big one recently, as whilst we've seen inflation decline in both Britain and the Eurozone, which we spoke about with the pound and euro just then, ultimately in the US we haven't seen the same kind of inflation action. And whilst, in Britain, inflation reached 2%, which is, of course, the Bank of England's target level, inflation within the US has stayed above and around that 3% level, which is kind of representing a very stubborn situation for inflation, which has worried many individuals because ultimately, inflation staying at that 3% is going to massively affect the economy when we compare when we compare it to the target level of 2%, which is, quite a bit of a difference. Now, ultimately, why this is also very important is because the US is also facing other issues, on the economic front, especially to do with growth. This has been a more recent worry rather than inflation, which has been a worry for the past 2 years, as really the US economy has remained strong over the kind of period of inflation that economies around the world have experienced for the past 2 years coming out of COVID. Now, though, after recent employment data, especially the NFP figures, ultimately many are starting to worry the US economy is heading for a recession. Now, the Fed has tried to calm those fears, and some more recent economic data that we spoke about last week has kind of settled those fears as well. But of course, that doesn't take away from the fact that these fears are new and they're growing, and ultimately it's a kind of situation of whether they now cut interest rates by even 0.5 percentage points to kind of make up the ground that they've missed out on not cutting interest rates, or keep their eyes on inflation and build that greater confidence that inflation is coming down before interest rates are cut, or interest cuts are made by a large margin. So that's what's facing the Fed at the moment, obviously, and what Fed Daly is arguing for is really keeping a more moderate interest rate cut policy, in which is more hawkish, obviously, but essentially more data is looked at, where they take their time and therefore protect the US economy from volatility. But we'll see what does come of this, with Murray also telling the FT that recent economic data had given her new confidence that inflation is in fact under control. So that's more of a dovish piece of news there from her, or more dovish opinion. This apparently has helped shape her current view that interest rates are in fact ready to come down. So she does believe that interest rates are ready to come down. That said, her more hawkish messaging regarding the topic of taking a slow approach to lowering interest rates fights the current narrative currently being set by economists regarding the worries about the US economy heading for a recession. The question of how quick to cut interest rates will be big heading into Jackson Hole, Wyoming, which of course we'll keep you updated on, as that is a massive meeting that's taking place this year, and not only this year, but within the coming weeks or so, or possibly is it next week? I'm not sure. I'll find out for you for next market briefing. But that's all to go out on the articles. Next to talk about, like always, is the charts, where some interesting things are playing out, of course, as US indices do rise to the upside to start off the week. Now, if we kind of look back on where the markets finished off last Friday, we can see, they kind of stopped around that Fibonacci retracement tool, which I did mark out, on Friday to kind of note where price could retrace to the start of the week and that sort of thing. We haven't seen a retracement at all, though, and instead we've seen price continue this push to the upside, with, markets pushing higher, and now, markets nearing that kind of Fibonacci extension level of minus 27.2. Now, if we zoom out on the Dow Jones, we can get some kind of perspective on where price is currently sitting, as ultimately these were the kind of recent highs made on the US 30, with this initial high being made on the 18th of June, on the 18th of July, pardon me, and this 31st of July high, of course, being made not too long ago as well. But obviously that was coming just before the NFP data, which did come out, and other data regarding the US economy, which did lead many investors to believe that the US economy was heading for a recession. And that's what was also echoed from economists, which is why we saw such a large sell-off. And this was repeated also on other US indices like the S&P 500 and NASDAQ, which we covered at the time. Now, where price is currently sitting, though, is very much near those highs. So it does kind of represent the fact that markets have somewhat become accustomed to, or kind of, eased with their fears regarding a potential recession. Maybe markets aren't thinking so much now that a recession is on their way. So that's the kind of thing that's seemingly playing out for the US 30 at the moment. The question will be, though, as we do go into Wednesday, it will be a question as we do go into Tuesday, it will be a question of whether price now reacts to that trend line, bearish trend line that I've drawn out, whether price does react to that and sell off to the downside, or in fact will price break through that and move higher. We'll obviously keep you updated, but definitely keep your eyes on the US 30. Next to talk about is the dollar, which has now broken through that lower level of liquidity and is now moving to the downside. Now, if you think back to last Friday's morning market briefing, price had just reacted to this higher area of liquidity, and not really high level of liquidity, but ultimately higher trend line, higher counter trend line, as ultimately, whilst that trend line had previously acted as an area of support, it was now seemingly acting as an area of resistance as price was reacting to it on Thursday and then sitting at it on Friday. And we did know, obviously, that it was likely that this trend line would act as a serious area of kind of resistance and allow for a kind of continued move to the downside to take place. And that is really what we have seen play out, as last Wednesday, we did see this kind of double bottom form at this lower level of liquidity around the 102.2 level, and now of course price is breaking through it to start off the week. So over the course of Monday, price has basically just broken through it, shot through it to the downside, and the question will be now whether price will reach that lower level of Fibonacci extension level of minus 27.2. So definitely keep your eyes on the dollar. Next to talk about is Euro USD, which, kind of reversing the image on the dollar, we're seeing a massive swing to the upside. And this obviously follows price tapping that 61.80 and key liquidity zone last Thursday, as ultimately since then we've just seen this significant swing to the upside with price breaking above this key area of resistance on Friday, and then to start off the week we've just continued this bullish move to the upside. The question will be now whether price will react to this Fibonacci extension level of minus 27.2, or in fact will price sell off to the down, or will price just continue higher and possibly make its way back up to these higher areas of price made around the 27th of December. So I will just quickly draw out that kind of key liquidity zone as we do head into this kind of area of price, it does seem. But yeah, definitely keep your eyes on Euro USD. Very interesting price action following last week's moves. Next to talk about is pound yen, which is currently sitting at the 190 level after having reacted to that 61.80 Fibonacci retracement level just last week. I did note that level as a kind of key area which price could react to, but ultimately I did note at the same time that it's hard to know where price could be going for the pound yen at the moment, just following the amount of volatility that of course price has experienced recently. Ultimately though, price has now reacted to that key area of liquidity and resistance, and now price has actually bounced off this other area of liquidity that we seemingly expect, which we originally expected to be an area of resistance, but is now acting as an area of support, as I kind of noted out or drew this over when price was back around the 7th of August, when price was underneath this key area of liquidity, and I did note how there was a chance that price would react to it and sell off to the downside, but instead price has broken above it quite slowly, but still broken above it, and is now kind of bouncing off it to use it as an area of support. So it'll be interesting to see what does play out, as there's both key bearish key bearish volume and also key bullish volume. So definitely keep your eyes on pound yen. Next about is Bitcoin, which is currently back within this key area of liquidity that's seemingly formed over the past week or so, 2 weeks nearly. So ultimately price is remaining within this key area of liquidity, and it does seem like last week's kind of false breakout was in fact a false breakout, not a full breakout, and that's why price is now currently sitting within this area of liquidity once again. So we'll see what does happen, but price remains near and around the $60,000 a Bitcoin level, but ultimately has not broken above it in a serious way since the Wednesday last week. So we'll definitely keep our eyes on Bitcoin. Next to talk about is gold, which is currently just broken above well, not just broken above, but ultimately over the course of last week we of course saw a great deal of bullish momentum enter the market, a great deal of bullish volume to enter the market, ending off last week as of course price reacted to that 38.20 and key Fibonacci retracement level of 38.20 and key the liquidity zone which lined up with that. And since then we've seen price swing to the upside, and that's kind of what we've seen play out further over the course, or actually we haven't seen the that play out over the course of Monday, pardon me. And instead, as one would expect, price has reacted to this higher area on the Fibonacci tool, and that being, of course, the minus 27.2% Fibonacci extension level. So we did expect, of course, a reaction at that level, as of course, orders are exhausted, and that's when people obviously sell off their buy orders, and that's seemingly what has taken place with this short retracement. The question is now whether price will actually have a proper retracement back into this kind of key liquidity zone, or in fact will price continue higher without kind of stopping for quite some time. But obviously, keep your eyes on events in the Middle East, and also eyes on what's going on in the US, especially with their economy, as that's really what's affecting gold at the moment. Lastly to talk about though is oil, which has now broken below the $80 a barrel level, which of course we were talking about not too long ago when we were talking about what economists are expecting for oil's price, and what's going on with demand and that kind of thing. So like economists expected, oil has now broken to the downside. The question is though, should tensions should things escalate in the Middle East, the question is whether we'll then see a return back to the upside for oil. So definitely keep your eyes on that commodity. Very important indeed to keep your eyes on that. That's all to talk about on the charts though. Lastly to talk about is the economic calendar, where lots of economic data is coming out this week. Well, not this week, pardon me. Lots of economic data is coming out today, and some very important data nonetheless. Now, firstly, we're receiving the RBA's meetings minutes, followed by the Swiss balance of trade figure, and then the Eurozone's inflation rate figure. Followed by that, we're receiving the Spanish consumer confidence figure, as well as the Canadian inflation rate figure. So not too much data, but still some very important ones to listen out for, especially that Eurozone core inflation rate figure and nominal inflation rate figure. But that's all about on the economic calendar. We've covered lots in the articles, lots in the charts, and lots in the economic calendar. We have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.